All right, let's talk about Lithium Americas Corp, ticker LAC. The market is closed for the weekend, and it finished Friday's session October 31st, 2025 at $5.50 per share, down another 2.14% on the day. Now, that price, $5.50, is the entire story. The common expectation, the narrative everyone has been clinging to, was that this company was just one step away from solving its biggest problem, financing. The massive multi-billion-dollar Department of Energy loan for the Thacker Pass project was the light at the end of the tunnel. And here's the reality that is confusing everyone. That loan is no longer a question mark. It's here. The company just announced it received its first drawdown of $435 million from that $2.23 billion loan. This is the single biggest de-risking event in the company's history, and the stock is trading at $5.50, just sitting near its 52-week lows. This is the ultimate disconnect. The expectation was that the moment the DOE funds started to flow, the financing risk would vanish and the stock would re-rate significantly higher. People on their Robinhood or SoFi Invest accounts, the ones who bought into the long-term EV story, were waiting for this exact catalyst. The reality is that the market met this colossal piece of positive news with a collective shrug. The stock is behaving as if the loan never even happened. This creates a massive curiosity loop. Why is the market ignoring the best possible news? Let's establish the common ground. The bull case for LAC, the story that's been told for years, is simple and compelling. You look at Tesla stock, you look at GM, Ford, and the entire global auto industry pivoting to EVs. They all need lithium, and they need it from secure, domestic, North American sources. Lithium Americas, with its 100% owned Thacker Pass project in Nevada, the largest known lithium resource in the United States, is supposed to be the answer. General Motors is already a major partner and investor. It seems like a logical, straightforward investment in the future. You buy it in your individual brokerage account, you wait, and you win. That was the expectation. But the $5.50 price is screaming a different reality. The market is telling us that the DOE loan, while critical, was only one piece of a much more complex and difficult puzzle. With the financing risk now moving into the rearview mirror, investors are being forced to confront the next set of problems, and they are not small. The first is the brutal, unrelenting collapse in the price of lithium itself. The spot price for lithium carbonate is down 70 to 80% from its peak. While we've seen some mixed signals in regional pricing, the overall trend has been devastating. A project that looks like a home run with lithium at $50,000 a ton looks terrifyingly marginal when it's at $10,000 or $15,000. The market has shifted its focus from can they get the funds to can they execute? And will this mine even be profitable when it's built? This isn't a tech stock like Nvidia stock, which can grow revenues 200% in a quarter. This is a mining project. It is a slow, dirty, and unbelievably expensive construction project. The $2.23 billion DOE loan is, of course, a loan. It's not free. It has to be paid back with interest starting around 2029, and that loan doesn't even cover everything. This is a cash-burning machine. The company's latest earnings reports show a consistent net loss. That's expected as they are pre-revenue. But the rate of the cash burn is what is causing concern. The market is looking at the $5.50 stock price and calculating the risk of future dilution. What if construction costs overrun? What if the timeline gets pushed out? The company will have to raise more capital, and at this stock price, that means issuing a ton of new shares, which dilutes every existing shareholder. So let's look at the recent stock movement because it's fascinating. The stock is scraping the bottom of its 52-week range, which spans from about $2.30 to over $10.50. This isn't a small dip. This is a structural repricing. For anyone who has been holding this in their Fidelity brokerage account for the last year, watching it fall, it has been an exercise in pain. The separation of the company in late 2023 to LAC for Thacker Pass and LAAC for the Argentine assets was supposed to unlock value. Instead, it seems to have just created two stocks that have both performed poorly as the macro headwinds for lithium overwhelmed any positive corporate restructuring. We are likely seeing a lot of institutional selling and tax loss harvesting. Portfolio managers at funds, maybe even those that feed into Schwab Intelligent portfolios, are looking at this in a risk-off environment and deciding to cut their losses. They can't wait until 2027 or 2028 for a possible payoff. They're selling to buy Apple stock or something else that has a fortress balance sheet today. So for those just catching up, what is the new Lithium Americas? After spinning off its producing assets in Argentina, the new LAC is a pure play bet on one single asset, Thacker Pass. That's it. It's a binary bet. The company's entire future rests on successfully building one of the largest and most technically complex lithium clay extraction projects in the world. This isn't a simple brine evaporation pond like in South America. This is a claystone deposit requiring a complex chemical process to leach the lithium out. While the company is confident in its process, it has not been done at this massive commercial scale before. This adds a layer of technical risk on top of the financial and commodity risks. It's a trifecta of uncertainty, which is why even some aggressive investors who use platforms like Interactive Brokers for their sophisticated tools are staying on the sidelines. This brings us to the future outlook. The entire narrative has shifted. The big catalyst to watch is no longer the DOE loan announcement. That's done. The new catalysts are all about execution and macroeconomics. First, we need to watch the construction milestones. Is the company hitting their targets? Are they staying on budget? Any update about delays or cost overruns will be punished severely. Second, and this is the big one, you have to watch the lithium spot price. LAC's stock chart is basically just a leveraged down version of the lithium carbonate price chart. If that commodity price doesn't recover, it doesn't matter how well they build the mine. The project's economics will be in question. This is the new expectation versus reality. The expectation is a world-class mine. The reality is a company tethered to a volatile commodity price it cannot control. So, what are the possible scenarios? The bull case is that we're at the absolute bottom. The lithium price has to recover because EV demand is not disappearing and a global shortage is inevitable. In this scenario, the DOE loan provides the bridge to get to production. By 2027 or 2028, LAC is producing 40,000 tons per year of lithium carbonate into a high-priced market. The stock isn't worth $5.50. It's worth $20, $30, or $40. This is the diamond hands case that self-investing retail traders are betting on. The bear case is that lithium prices stay low for longer. The energy transition takes more time, or new battery technologies reduce lithium demand. In this world, LAC finishes construction, but the project struggles to be profitable. The company is saddled with billions in debt from the DOE loan and may be forced to dilute shareholders constantly just to service that debt. In this world, $5.50 might even look expensive. The market is pricing in a future that is much closer to the bear case than the bull case. The good news about the loan is being completely overshadowed by the bad news from the commodity market. I want to know what you think about that key variable. Comment below what you think the price of lithium carbonate will be when Thacker Pass starts production. Do you see it recovering to its former highs, or are these lower prices the new normal? To summarize, that $5.50 closing price for Lithium Americas represents a profound conflict in the market. The expectation was that the $2.23 billion DOE loan would be the all-clear signal, solving the company's biggest risk and sending the stock soaring. The hard reality is that the loan was just the starting gun. It's the beginning of a long, expensive, and difficult race to build a massive, technically complex mine, all while fighting the brutal headwind of a collapsed commodity price. The market's focus has shifted from financing risk to execution risk and commodity risk. This is no longer a simple story about EVs need lithium. It's a far more complex story about project finance, chemical engineering, and global commodity cycles. The expectation was a simple online investment in the future. The reality is a high-stakes, high-risk bet on timing, execution, and a commodity price recovery.